Alan, Darby, Jacqueline, Martinez. This is the Buyer's Boardroom. Learn the most about who you are today and where you want to be after.
All right. Welcome back to the Buyer's Boardroom. How's it going,
It's
Alan?
going good, Jacqueline. Good to see you. We're just dodging ice storms here in the South.
Right. I might go to the beach in a little bit. We'll see.
I've got a trip coming to Mexico in a few weeks, and I'm counting the minutes.
Well, glad we could take some time today to film an episode amidst all of that.
Today's podcast day for me. I was just a guest on the podcast, which are our friends at Modern Wealth Management. They had me on talking about auctions and minority versus majority acquisitions. It was a great episode. So yeah, my second podcast in a day.
I look forward to listening to it. I know Gary Roth and Jason Gordo and, would always have a dynamic conversation about anything.
Yeah, I was telling Jason, between he and I, there's not a lot of air left in the room when we talk.
Chatty Cathy's. Well, perfect. Okay, well, we'll keep the podcast day going. Been thinking a lot about calls that we have where it's firms that have not done acquisitions yet. They're looking to get into the acquisition space, if you will, and just seeing, firms that are just starting out, but then even ones that aren't winning deals and that are super active, have done deals, but they're just not winning the deal for whatever reason. Kind of got us thinking about what it takes to stand out right now.
As a buyer.
And
yes.
As a buyer.
Yeah.
Right.
Well, it's funny because we get emails or calls every week from firms, and we represent the seller. They're our clients, but we often get contacted by firms who tell us, hey, we want to be a buyer, or we are a buyer. Maybe we haven't done a lot of transactions, but we would love to be on the Alaris roster. As you know, we have buyers that they're not our clients, but they're on our roster, which means they give us all their information and helps us do our job when we're matching buyers and sellers together. And so we get a lot of these inbound calls or communications, which clearly identify there's a huge interest from buyers who want to break into the acquisition game or improve their acquisition strategy. We've done that ourselves back in our United Capital days. We work with all of the top buyers in the country, so we get to interact with them. We sit in a very unique spot, actually, where we get to see the corporate development teams work and interact with sellers at the highest level, like the biggest, most successful M&A firms in the country. And so we thought, why don't we do a quick little show and maybe give our opinion on what you need to be prepared to do? What are some really important things to bring forth into the conversation with a prospective acquisition? What not to do, where we've seen things go awry or buyers start to err and puts them in a bad spot such that they don't win the deal or put them in a good position to win the deal. So maybe let's just start like as an opening kind of thought as to what do sellers tend to prioritize, in just how they are vetting potential partners. That's a big question. There's a lot of things that go into that, but what are they solving for, would you say?
I think it could be anything from solving their succession plan and taking some chips off the table and those types of things. But setting those aside, I think they're solving for wanting continuity and they're seeking certainty and they want to trust who they're doing business with.
Yeah.
And all of the other things matter, but it's those feelings when they walk away from a conversation that will lead them to the right part.
That's a great point. And that buyers, like I would certainly tell a buyer who's looking to get into it, is you need to start with a foundational understanding of the reality of the seller's mental state. They have never done this before, likely. And even though many of these sellers are very intelligent, they're very rational people in their business, at least, they're very successful, this is the first time going in this. And there's a bit of fear that's kind of foundational to where they're at in the process. Like they're trying to get educated, they're trying to support, but they're contemplating stepping into a world of the unknown. And so the buyers need to recognize that. And so to your point of looking for certainty, looking for continuity, looking for trust, excellence in execution, all of these things, it's easy to speak to as a buyer, to tell them you're going to be good at all that stuff, but it's how you flow in the process, how you communicate with them, acting like you know what you're doing, that subtly communicates all of those things that they're looking for. So that's really important. Sometimes they think it's more like a manufacturing line. They just, there's another deal and they're just going to bring them through, and here's our offer and here's our, what we do for you. And they really step out of that human element in the courtship. And you got to not do that, So, and that's something like we can go down a list of items that, let's say, sellers quietly rule out buyers.
Quietly to the buyer.
Yeah. Sometimes the buyers are like, they got removed from the conversation. They don't really understand why. And I would put at the top of that list, that early connection on that first introductory meeting with the seller is, how do you make them feel? Are they just another deal to you? How important they are, how much of a priority you want to make them. We see this more in buyers who've done a lot of transactions and they get into these introductory calls. It does seem a little bit like their 10th call of the day, and they lose that personality, compassion, or the empathy with the seller. Like this, this is their 10th one of the day, and this is the first of a seller's entire life.
Just press play on the pitch, and
What else would you say?
I would say it's when you were mentioning the deal structure and how that, like, if everything feels straightforward and intentional, those moments of trust break down if the deal structure is really confusing. They can't understand it. They just start to wonder, how hard is everything going to be working with you if we can't even agree, or like it's not easy to understand how certain calculations, what needs to be true for certain payments to be made, when it starts to be confusing.
This is a big one for the firms who haven't done an acquisition yet, or maybe have only done a handful. And so their articulated story, their articulated value proposition, how clear they represent the deal structure, post-acquisition economics, post-acquisition autonomy, all of these things, the more you say stuff like, oh, we'll get to that later, or we'll figure that out as we go, or, we're very flexible on that kind of stuff, that you may think you're communicating a degree of flexibility, you're communicating a lack of having your stuff together, as a buyer. And so before you in earnest start having interactions with sellers, and we're going to talk about this in a little bit, about the value proposition that buyers bring to the table, you need to have a very clear message, not have much ambiguity in the conversation, because it does not come across the way you might think it comes across, as being flexible and entrepreneurial and all this stuff. It comes across as like you don't have your act together. And you have to keep in mind, if you're having a conversation with a seller, they're likely having multiple conversations with very sophisticated buyers who do have their ducks in a row. It'd be like a client coming in and interviewing you as their financial advisor, and maybe interviewed 5 others in the previous week. The 5 others just nailed the message, nailed their value proposition, nailed everything, and you're just more aloof and all over the board. In a very close period of time, they're evaluating multiple interactions. And if you don't have your stuff together, you're not going to look very good. Yeah. One thing that I would say is that the assertions that you make in terms of the benefits of joining you as a buyer need to be supported by data. For example, if you said something like, our partners grow on average 25% a year post-acquisition, or we can generate X amount of organic lead flow, whatever the data point is that you're asserting as a benefit to joining your organization, you need to have data. This is something that surprises me, and I would say even with some of the larger buyers, is how they'll make comments on these benefits, but they don't really bring any supportive information or data behind it. And so when pressed, when they start poking and prodding on certain things, you'll see very quickly that they only have maybe 60 seconds worth of conversation around the topic before you've exhausted their supportive information for their assertion. So don't claim you're going to be able to do things, help them improve their life or whatever without having supportive data behind you. I think that's very important.
That's so true. Yeah.
What about like the perception of collaboration versus like an our way or the highway type of approach? I see that. And shockingly, smaller firms are often really notorious at this. They have a way of doing things. It could be an investment philosophy. It could be a way of their client experience. It could be a tech stack, what have you. And they take a very rigid, dogmatic approach to no, whatever you're doing, you're going to stop doing that. You're going to adopt our way of doing everything. And if that is your approach, fine. Again, you have to have data that supports why adopting their way of doing things is going to be an improvement to them. But sellers largely don't want to be dictated to. They don't want to be treated like a rank and file employee who has no say or contribution beyond, their serving clients. So I would say articulating a collaborative environment. I know we're not saying they got to join the C-suite or anything like that, but being able to communicate how you interact with your partners post-acquisition in a way that gives them meaning beyond, again, their role as serving clients. Do they have a voice? How does their opinion help shape the direction of the company, if at all? Having that more of a collaborative approach definitely will bode well for them, I think.
Right. So you're talking more about like being involved in other ways and like contributing to the overall organization or
it doesn't necessarily, because the reality is, many sellers don't want to contribute beyond their local office and working with clients. In fact, many of them are looking to get out of that stuff. Many are not asking to affect change at the highest level, but they are wanting to be listened to. They want to be heard. If they express a view or an opinion, or maybe something's wrong, or they perceive something to be wrong, that there's someone that's going to listen to them. They're not just going to be given the hard hand. So anyway, just having a collaborative kind of vibe as you're entering into these conversations will be very good. Another one would be, all firms want to grow. Okay. Like that's the name of the game. We want to grow. Many times you're looking for a seller who has an articulated desire to grow. Often you may have organic growth that you contribute to the seller as a buyer. That's one of your value propositions. But how do you align your articulated desire to grow for the seller with client service expectations? Sometimes the buyers talk so much about growth, grow, that the seller hears, well, how are my service standards going to go down? Am I going to be able to support and work with my clients as much as I do today? If I'm spending all my time in these new business development meetings, who's working with my existing clients? And so having an understanding that we know you want to grow, buyer, but we also don't want to feel like our clients are going to be adversely impacted because we're spending so much time about growth. So making sure that whatever you're saying in terms of growth, you're also articulating, we understand the client service standards can't be sacrificed. If anything, we want to see those go up. And here's how we're going to do it. It's not only growth, but we have all these other resources and things that are going to help us serve our clients better.
I think it's also like acknowledging that it's hard for a seller to imagine a world where they aren't wearing all of the hats that they are today. So when a buyer is talking about those things and more growth, it's hard to separate in that moment, adding more when the other hats haven't been removed yet.
100%. When sellers articulate what they can do to help them grow, they react based on their current reality, which, to your point, they're not only working with existing clients, but they're the head of HR and accounting and compliance and all these other things. When they hear, oh my gosh, they're going to help me grow, they're like, well, how am I going to be able to handle all that given the stuff? And what you're saying is they haven't yet made that mental leap of saying, yes, this buyer is going to be able to help me grow, but I don't have to spend 20 hours a week doing all these other things. So it's growth in their world, not growth in your current world. And so making that connection as a buyer is really important as well. So great. Okay. Well, good. So how a buyer should be thinking or things to be prepared about coming into it. Really excited about our guest today, Michael Dolberg of Pollen Wealth Management out of Charleston, South Carolina. I've known Michael for probably 5-6 years. I met Mike in Charleston. We had lunch together, and he was about 800 million in assets in his partners. So to watch them grow from 800 million then to over 8 billion today is nothing short of phenomenal. And so can't think of anybody better to ask than Michael. He was in the shoe of the firm that hadn't done acquisitions, and they started slugging it out in the streets with everyone else, not knowing what they were doing. And now they're one of the better buyers, I think, in that we call them regional buyers, and that between that 10 to $20 billion size. So looking forward to asking him how he did it, maybe sharing some war stories. So Michael Dolberg of Pollen Wealth Management.
Yeah, super excited to have him on. And him and his whole team are so nice to work with. Shout out to Mike Herman.
Right. How can I forget? Mike was our former compliance officer at United Capitals, now the compliance officer at Pollen. So best compliance officer I've ever met.
I know. People can't believe it, but it's so true. Okay, well, before we jump back into the content of today, I was thinking about a recent story. You were in charge of a recent deal where we were nearing signing the purchase agreement, and sellers having all of these feelings still of not sure if that's the right deal and continuing to bring new buyers into the process when we're at the finish line.
Yeah. Well, here's what happens. Everyone is banging as a seller. You guys are getting emails, calls weekly, daily. And so that never stops. Even when you enter a formal process, such as working with a firm like Alaris, that doesn't stop the marketing attempts of these buyers, right? And if you're an Alaris client, we have a whole way of notifying anyone who's contacting you that you've engaged Alaris, you're in a formal process, and that kind of thing. However, knowing it doesn't stop it, this situation was, to your point, we're past LOI. We're days away from signing purchase agreements. And I'm on the golf course, actually, and I get a call from the seller wanting me to potentially engage this buyer who had not been in the picture for over a year now. We've been working with this client, and wants me to potentially bring him in to the conversation. He actually knew the person. And so I was like, not only is that a bad idea for multiple reasons, but it's incredibly awkward. And because effectively, like, we could have done it. Fortunately, this seller is a very rational side to him. And after talking to him about the pitfalls of making this maneuver, concluded that wasn't a good idea. But what are you saying if we were to notify the buyer who was expecting to sign purchase agreements like within a few days that, hey, we're going to bring in another potential buyer into the process. We need a few more weeks perhaps to get this. What do you think that buyer's reaction would be?
Pound sand.
Yeah. See you later. Deals off. Exactly.
Deals off. Like, you're too volatile. I don't want to do business with you.
Yeah. I mean, think of it. Yeah. And again, the seller recognized what we're telling the audience now. And so he behaved rationally here. But if they had forced that deal would have been off. And it happened to be a phenomenal outcome for him economically. I think the culture, all of that is a great fit for him and his team. And he would have basically lost that offer on the hope that this firm, who had not seen his financials, not seen anything about the practice, it was just a relationship that he had. That firm as a buyer would have taken easily 30, 60 days to get to a point of being able to even make an offer. And so you're throwing away one that you were obviously convinced enough to get to the point of signing purchase agreements was a good deal, on the hope that this firm would be an improvement culturally, economically, and all the rest. And boy, what a bad decision that would have been, So that was one of the crazy things. So if you're at the point of signing deal documents, that is not the time to even think about bringing in a potential new buyer. If someone came in with a phenomenal offer that, was a bankable offer, meaning it wasn't subject to post LOI diligence, which, anything can happen,
Yeah.
it's just not
Yeah.
cool to do that sort of stuff. So yeah, so don't do that. If you're thinking about it, once you sign an LOI, you can still maybe, but unless you're under standstill, don't bring in new buyers hours before signing the purchase agreement.
Right.
So
It's a testament to deal fatigue setting in. You just start to question things as time goes on, and how do I know I got the right deal, and the freak out moment.
That's right. Well, that's a good point.
So,
that was a form of freak out moment. Everyone has it. We've talked about this
Mhm.
in multiple episodes, where you as a seller,
Yeah.
given that this is an intellectual journey, but it's equally, if not more so, an emotional one. At some point along the journey, will likely have your freak out where you just lose it emotionally and you start behaving irrationally and asking all sorts of questions about the boogeyman behind the door that doesn't exist. And we are here
Right.
to help you. When you go through that part, we know it's coming. We just don't know when. And that's probably a good example of one.
Right.
Yeah.
Don't text your ex while walking down the
That's
aisle.
right.
Okay, let's jump back in then. So maybe we just start out too with being competitive in today's space. Like, what does that mean? Because it's really evolved since our United Capital days, where there are only a few aggregators. And now there's kind of the table stakes level of things that anyone who's acquiring needs to provide. And then what are the kind of differentiators above that, above and beyond those, that may move the needle for certain sellers?
Unfortunately, when we talk to buyers who are just trying to get in the space, it comes across as we're not very encouraging, let's say it that way, because it's such a competitive landscape today. To jump into the fray at this point, it's difficult. It really is difficult from every measure. And so if you are going to do it, I did it, seen many firms successfully launch into an inorganic growth strategy and do well. But if you are going to do it, there are certain things that you need to be able to speak to and have an answer for. We call it the buyer value stack at Alaris. And it's essentially when you're out there competing and you're telling your story, because again, they're talking to other buyers too. What are the compelling reasons that they should choose you versus another firm? We've seen some buyers come in and just throw bizarre checks around, and they will win in some situations, but it's never worked out in terms of the post-acquisition happiness. They end up with what this guy called it a Franken firm.
Bolted on.
No real path to integration. So beyond the check, what are the things that you have to be able to offer in terms of a value prop to your potential new partner as a buyer? The first thing, which I think is table stakes, is operational burden relief. Get me out of compliance, get me out of tech management, get me out of HR and payroll and accounting and all these functions that suck up time in my day as an owner of an RIA, but don't move the needle for growth. They don't really reward me personally. Everyone does that. That's sort of like the part of the deal now with everyone. And so you need to be able to speak to it and show them how you integrate those things and how those hours come off their work week and thereby giving them capacity. But just know that that's table stakes. So have a very articulated story around operational burden relief. The second one I would say would be how you improve their quality of life. And that to me is practice management. Practice management is one of the least talked about, but most impactful ways a buyer can help their partner. And that's essentially, how do I operate my office locally? Defining the roles in my office to support my client experience. Do I have the right people in the right seats? Who does what on what days? Can you help get the rainmakers out of non-rainmaking functions? Can you help the generalists in my office gradually migrate more to niche specialty roles? That's all classical practice management stuff, but huge impact to you. Once you've gotten off your plate all those operational functions, now turning your office into a very well-oiled, streamlined operating machine is a huge win. Customer satisfaction goes up, client terminations go down, your employee satisfaction will go up, your profitability likely goes up. All of these metrics, again, the buyer should have the data to support this, but all of these things improve in your life. We used to call it institutionalizing the business. you're a business, the classic lifestyle business where everything depends on you, that's not a great business. You run a lifestyle business when you go on vacation and you can't put your phone down. Your office is calling you, your clients are calling you, you're pacing up and down the beach on the phone while your family's lounging. That's a good indicator that you have a lifestyle business. And so having a partner who can bring practice management expertise that helps relieve that issue is a huge win. And all buyers don't have that as a component of their value proposition, but I think it's a phenomenal one. So practice management. Next, I would say is expansion of services and capabilities. How do you help me go beyond the basic service of financial planning and investment management? You think of those as the two bedrock services we all offer: tax preparation, risk management, qualified plan expertise, corporate trust services, investment banking. There's a whole host of services that buyers bring to the table. Is that a part of your value proposition or a proposed part of your value proposition as a buyer? Because many firms have that. I can think of a number of firms that, when you join them, and if all you were doing is planning and portfolio management for your clients, instantly you have all of these other services with bona fide experts. You don't have to do all of them, but you have team members now that can come work with you and your clients, which makes you more valuable to your clients. So I would say that's a really strong one as a buyer to contemplate. How are we expanding our partners' services and capabilities? Next, I would say, how do you help us grow? There's a lot of ways to grow. Most sellers are just referral, word of mouth. They don't really have anything strategic or niche oriented. And there are a lot of buyers out there who are able to drive organic growth. It could be the custodial referral programs. Maybe they're great at event marketing. They may have niche expertise like serving pilots or something, and they have really deep resources that if you wanted to go after that market, they could help you with. They have full-time marketing departments that is their job, is to help their partners figure out what is their best path to growing, and how do we implement strategic and ongoing marketing initiatives that drive that growth. And again, growth in their world, not growth in your world. I'm sure I'm leaving out a few. Anything that you would add in terms of a value prop or story that they should be able to tell?
I think the things you've listed so far, these are great for explaining to your team and your clients why you're making the move and the benefits to them as the founder, the owner. I think really understanding the buyer's equity story.
Right, yeah.
And part of the purchase price is rolling equity into the buyer. Then you want to really understand the historical growth rate, the plans for continuing to invest in the business to help them get to the next level. And I guess part of that too would be the ongoing compensation model. So as new clients are added through the growth channels, how are they growing income over time to try to get back to historical levels pre-deal, and seeing a path for that?
No, great point. So I'll take the first one, the equity story. That's a great question as a buyer. Are you going to offer equity in your deal or not?
True.
We see a lot of firms, smaller firms, who are getting into the M&A mode. Initially, they're like reluctant, like, we're not doing any equity in our deal. It's an all cash offer. Well, okay, if that's your position, fine. Just know who that's going to attract.
Right.
You're likely going to attract older sellers who are just looking for a check and wanting to exit the business. And
Right. Who probably are serving older
Correct.
clients. And so you're buying a business that's in distribution mode.
That's right. And so I think if you want partners who are going to align to your vision, they are going to be interested in growing because they're incentivized to grow through the equity story and the ongoing sharing of economics. It's really important to have equity as a component of your offer. Not a mandate, not a requirement, but like I see, the majority of the sellers we work with tell us, yeah, they want to take some chips off the table, but they still want to be an entrepreneur and have some skin in the game.
Right.
10, 20, 30, 40% of their valuation, they want to roll into a buyer's equity. And so do you offer equity, and what is the equity story? You need to have a projection of what you think your equity is going to grow to. We all understand that's not a guarantee, but you at least have to exhibit some confidence as to what we think our equity is going to grow to. And then you need to have some commentary around future liquidity. What is my path to liquidity? Understanding you might not know yet, particularly if you haven't
Right.
taken on a permanent source of capital, you're just using cash flow and debt financing. You might not know what the liquidity event is going to be. And so you have to say it that way. Like I know many successful firms have said, we haven't figured out the ultimate liquidity for our shareholders yet. We're focused today on growing a world-class business. And in doing so, will avail us to ample pathways to liquidity. It's a very valid answer. Some firms, some sellers won't like that, but that's the truth. Are you going to take a private equity sponsor? If you have, we likely know what your liquidity looks like. It's a form, continued recapitalizations of that. But having a story, and to your second point, what does the ongoing share of economics look like? Simpler is better. If you have a comp structure that requires a full spreadsheet, narrated with notes and PowerPoint to describe how they earn $1 for every new $1 of revenue they bring in, not great.
Got to keep it simple.
Keep it simple. Yeah. There are some, for example, who have like these base salary and bonus programs, but the bonus is ambiguous. It's tied to company goals, not their individual performance as an advisor. Right. And that I understand the rationale for that as a buyer too, but just know that it's tougher. When again, they may be talking to other buyers who their comp model is 35% of top line revenue. Bam, period. Right. That's it. That's easy to understand. Right. And so have a comp plan that is market and then one that's very simple and easy for them to understand. So
I think that makes sense. As much as sellers want certainty on a lot of things, the base bonus model is like attempting to solve for that. Okay, like you're no longer eat what you kill model. It's you have these guaranteed amounts, but they're fixed. And that's not really that attractive. They're used to being an entrepreneur and being able to grow their income as much as they want and can. Having a cap, they're not looking for certainty there. They're looking for upside and they're bullish on their ability to deliver.
Exactly. That. And generally speaking, when we have buyers who have that base plus bonus structure, bonus is tied to these ambiguous corporate goals. Their general rationale is we want everyone thinking about the business. We want, as shareholders, we want everyone focused on just improving the global business, not necessarily focused on their own individual performance, perhaps to the detriment of the global success. And my only comeback to that is, well, if every advisor on your team, because they're incentivized to perform, is performing, wouldn't that drive the overall success of the total enterprise? It seems like that would be a common sense assumption, but I'm not going to tell you how to run your comp plan. But we've seen the seller, in many cases, they just can't understand the economic plan, nor can we, by the way, and we think we're pretty good at this.
Right. We do this.
Yeah, we can't understand it, and therefore they just lose confidence in it. And they start thinking, well, if I can't understand your comp plan, what else am I not going to be able to understand as your partner or your teammate? It's just, if you don't have an answer for all those points of value proposition that I went through, if you don't have a firm grasp of your deal structure, the equity story, the economics, every time you don't answer that question or scenario clearly, you're inserting a lack of trust, a lack of stability, and they don't want that, and so you've got to have your ducks in a row on all of these points. And so I know it's a lot for all those who are considering being a buyer, but you look at all of the successful businesses that have just really knocked it out of the park in M&A, they do. They have answers to all of these things, and they're very good at explaining it. And that's why they succeed.
Yeah, that's good. Perfect. The main point about that too is there's no right or wrong answer for every one of those points. It's about being clear, and there's so much opportunity on the seller side and the buyer. So just be true to who you are and what you're trying to attract, and have a deal structure that aligns for that. So all of that said, price still does matter, though.
Does.
So maybe,
I knew we were going to get
as much as I love an underdog.
Yeah, look, this is something that, as a new buyer coming into the business or coming into the game, you probably don't have a permanent source of capital.
Funding it out of cash flow or, a loan.
And so when it comes to price, you probably won't be as competitive as the larger firms or let's just say the firms who do have a capital source, like a private equity firm or, other types. So how does that impact your ability to succeed? Well, I tell firms like, look, you don't have to be the highest bidder to win an opportunity, but you can't be so far off market that it compels the seller to go elsewhere. And what do I mean by that? So if you were 1 to 2 turns of the multiple off from like a PE-backed firm or a firm with a permanent source of capital, you can overcome that. You can overcome that by the relationship. You can just do better at trying to build rapport with your prospective partner, because some of these mega firms, they're courting 20 firms at a time. And so you can give a lot more attention than they can. And that matters. You might have more opportunity in terms of the collaboration. Maybe you can offer them a seat at the table or a seat somewhere in the firm where they feel like they're making a contribution. You can tell the story of, hey, lock arms with us and let's go build the next Mariner, or next Cap Trust. That's appealing to a lot of firms. That's tied together with your equity story, though. You can win even though you're not the highest bidder if you have a lot of those attributes baked into your model and you're excellent at all the points that we've already covered. You don't have to be the highest bidder, but you can't be like 4 turns off the multiple. We see some firms come in, and let's say that the market is 10x EBITDA for a seller, and they try to come in at 5 or 6.
Right.
It's dead on arrival. It's just not going to happen because, one of the guys I respect most, Carl Hackenberg, at Constellation, told me one time, he's like, culture is code for cash. He was saying that tongue in cheek, but I do get his point. It's like culture is really important. And we find most sellers, good advisors who care about their team and their clients, are dead serious when they say we have to have a great cultural fit. I will not sacrifice my team and my clients for $1, right? They're very serious. However, if you think you're going to win and you're offering 50%, 60% of market value, it's just not going to happen. That's a reality that you have to be prepared to be somewhat market competitive. And if you find yourself behind, you've got to have a really excellent story in that value prop chain that we covered. Your equity story has to be excellent. Your ongoing share of economics. That's an area you can win as a seller who can't be competitive price-wise, is you can offer a higher share of ongoing economics. Instead of like a 35% share of top line, maybe you're at 45, And so these are little things that you can do, but you can't be so far off economically that it just compels the seller to look elsewhere, because they will find a cultural fit somewhere that has the ability to write the check that reflects the true value of their business.
Sellers are really getting educated, and, not all information out there is accurate and spot on for their situation, but they understand what market pricing is for their business. And, hopefully you're lucky enough to, like, as a smaller buyer, to have just a solo conversation with that seller and they're not exploring with other options. That's probably the better way to get into the acquisition space versus participating in an investment banker led process where there's other PE backed buyers that just can afford to pay a lot more.
Yeah.
And
well, that's true. Like if you hire an advisor like Alaris, it is going to be a competitive environment. We've had previous shows where we like to think we're substantially different than other bankers, but or M&A advisors. But it is very important. You have to be competitive there.
All right. Switching gears here to just some kind of more of, I would say, like style mistakes that we see of silent killers, kind of going back to that earlier point. So, we have the resources, the balance sheet, we have those reasons why a seller may pick you. We touched on this a little bit, but that connection with the buyer's leadership team, sellers sell to people, not logos. Be responsive, be present in meetings, do your homework before a call. We've talked about this a little bit, know where they custody, know where they're physically located, know their team, read as much as you can before the interactions, and require your team as well that's interacting with the sellers along the way so that they feel important. It matters a lot.
Look, it's not hard. Yeah. It's just, if you were trying to win a client, you would probably do substantial research on that client try to learn as much about them, not only professionally, but personally, so you can establish multiple points of connection with them, speak to what their true needs are, perhaps perceive what their issues are going to be ahead of them. And it's no different here. And that's where I think smaller firms can actually really win. Again, to my point, the larger firms have full corporate development teams, often many of whom have never been an advisor. They don't know what it is like to be an advisor. They're financial analysts that are great people, but they haven't sat in the shoes of an RA owner. And it's difficult for them to communicate in some cases to them. And again, they're doing so much transaction volume that they can't pay any single one of them a great deal of attention. That's where you can really shine by, proving, by doing the work, studying. If you're working with an advisor, look at the materials that they've provided and be prepared and very well versed in them. And I like your secondary point. Get your teammates up to speed as well on them. Don't let your head of investments or head of planning or whatever go into a meeting with them and not know who they are and what the relevant talking points are going to be, But with that said, you've got to slug it out. All of these buyers who are doing, 20 transactions a year, they started out just like you, where they were, clawing and scratching to get in front of people, selling vaporware sometimes, and winning these kind of off the market, type transactions. And I like to tell buyers, like, your standard of who you want to buy can't be you. In a tongue-in-cheek fashion, like, you're a swan and you're trying to buy some ugly ducklings, and you're going to make them into a swan as long as, ethics and shared values are there. Don't expect them to be great operators. They may have some hair on them that you're going to clean up, but if they're good people, they can articulate alignment with your overall value proposition. They don't have to be you, and that needs to be communicated to your team as well. Because often when you get your team interacting with them, they'll come back and say, oh, these guys are not as good as XYZ as we are. Why are we partnering with them? Well, that's the point. We're going to make them as good as we are in these cases, because they're humble, they're willing to change, they're willing to do our stuff, Yeah,
that's good. Well, I think it probably makes sense to jump to the interview.
Yeah. Right in.
So let you take it away with Mike Dolberg, and see you in a bit.
Right. Alan Darby, CEO of Alaris Acquisitions. I am here with Michael Dolberg, the CEO of Pollen Wealth. Michael, welcome to the Buyers Boardroom.
Thank you. And by the way, you can call me Mike. I feel like I'm in trouble.
I'm going to call you Mike from here on.
Yeah. My wife calls me Michael when she's pissed at me. So anyways, Mike or Dolberg, one of the two.
No problem. Well, Mike, it's a pleasure having you on the Buyers Boardroom. We've known each other for many years, and we've just really enjoyed watching Pollen grow and succeed in the way you guys have. So this will be a fun chat with you. Today, Jacqueline and I are talking about what makes a good buyer, and really trying to tackle some of the issues that buyers deal with, talking about some things that sometimes they do wrong, and really juxtaposed against their journey as they started out, not being like a serial acquirer, their first few deals, struggling through that, really getting their feet underneath them, progressing all the way into the strategic national type of buyer. And so we thought, well, who better than to talk about this topic than Mike? Given, I think when we met for the first time, I know we had a lunch in Charleston. It was 7 years ago, and you were maybe at 600 million in assets. And so what are you today in terms of your top line? That changes a lot.
Between AUM and some of our BD assets that our advisors have, around 15 billion.
15 billion. So 800 million to 15 billion in about, call it 6 years. So
I think we met March of 2020, when we were 440 million.
440, yeah. I stand corrected. Well, that's even more impressive. So, well, before we dive in, so I've got a lot of questions I want to ask about your journey in M&A. But why don't you just tell us a little bit about Pollen Wealth, maybe a quick 2-minute commercial on, what you guys stand for, anything that you would share with the audience just to get them familiar with the firm.
Sure. So I'm just going to talk about general Pollen, if that's okay with you. So Pollen, sort of the Pollen companies, is comprised of Pollen Wealth, Pollen Financial, which is a separate RIA, and then we have an insurance wholesale distribution called AIS. So we started the firm February 15th, 2018 with a mission to enrich the lives of others through collaborative financial planning and engagement. And we had a vision of being able to execute on that by creating an environment where we could deliver multifamily office services and solutions up and down the income spectrum. That is us today, right? That is what we do. We have a really healthy interdependence of what we do centrally versus what happens at our local offices where we structure them as partnerships. And so Pollen Wealth was our primary RIA that's multi-custodial, Fidelity, Schwab, Pershing, Raymond James, Goldman Sachs. And then we set up a separate RIA, Pollen Financial, which is very specific to LPL. And so we wanted to make sure that we could work with, there's some great teams in the LPL universe, and we wanted to make sure that we had the ability to continue to work with them. And so that's why we have the two RIAs. And AIS is just a totally separate business line. Obviously, as a financial planning, multifamily office firm, first and foremost, we want to make sure that we can sort of be the center of the clients' lives. And so that also means that we need to address not just the asset management and the planning aspects of things, but we want to make sure that we can help them mitigate the risk. And so we decided that we were going to create that company in-house. And so that's a Pollen sort of in general. Happy to dive deeper in any and all things, but I think you kind of get the gist.
Yeah, well, I'm interested in, so maybe take us back to the beginning. I know you have a partner and you guys came up with the idea for a Pollen, but specific to M&A, before you took on a capital partner, so what was your vision for acquisition growth?
Yeah, so honestly, it's no different than what I just said. So my partner is Rob Gorman. The two of us have worked together since we were right out of college. And prior to starting Pollen, we worked together at our prior firm and sort of, built that local presence together. And, we did that at an independent broker dealer that was also at an insurance company. Mm-hmm. Good company, just was not really conducive to what we wanted to build and do. And so the two of us decided that we were going to leave separately. We did not talk to each other and say, hey, I'm going to leave. And he was like, well, let's figure out what to do. I just went to him one day and said, Rob, I got to tell you that I'm out of here. He said, thank goodness you told me I'm thinking about leaving too. And then we started talking about what we each wanted to build. We wanted to make sure we were a financial planning and business consulting firm first and foremost. We wanted to deliver those multifamily office solutions up and down the income spectrum. What we wanted to make sure we did is that we could deliver a really exceptional and consistent experience from one client to the next. And we wanted to scale beyond just Charleston, South Carolina, which is where we were and where we both live now. Earlier, when I was talking about a really healthy interdependence of what we do centrally versus what happens locally, it is an interdependency between our central location and our field offices. And so I think that was it. We just wanted to find people that philosophically and culturally believed in delivering that kind of client experience. We thought we could go and try and recruit in people from outside of the industry, develop them, train them, which is what we had done in the past. Or we could just find people that have already established a real presence in their marketplaces that were doing the things that we wanted to do. And through partnership with us, we could just all grow faster. And so that's sort of when we decided, hey, let's not just grow locally in Charleston, but let's try and find some good partners across the country.
Got it. So, and by partnership, and we use that term, by the way, at Alaris too, because we know what joining, in this case, Pollen means, and it really is a partnership. But that's somewhat code for acquisition, whether it's a minority or a full acquisition. That was sort of what came. That's how it kind of leads. So let's take what we know what we can build and export it to other markets, not be just constrained to your where you were previously.
That's right.
Yeah. Well, tell me how is it going? Just describe what it was like as a startup firm trying to break into the acquisition space. How hard was it? Because that timeline was right around, I think, where M&A really started exploding. It already had probably a 5-10 year track record of success, but it really started accelerating. And so there's a lot of other firms competing for those same potential partners. What was it like? Was it harder than you expected in those early deals?
Everything is always harder than I expect it to be. It's always harder. So, we always feel like we can bite off more than we can chew. We always think it's going to be a little bit easier than it is. But I'd say for us, something that really helped us in the prior firm that we worked at, we had to recruit in people. And so that's very different than M&A, don't get me wrong. But just the general process of understanding, got it. Like, I need to talk to a certain amount of people so that I can identify right away people that are not the right fits for us. And M&A is the same thing. I mean, it's talking to the right people, figuring out whether or not culturally we're compatible, what are going to be the pain points of actually integrating people in, and just like, how do we grow together, and can we afford to buy all or part of this organization? Do they want to sell any part of it to us, right? So like, we have a little bit of experience in that from our prior company. So coming over to, and starting up our firm wasn't like, we didn't have that learning curve, but the difference is we worked on a platform. Now we were trying to build a platform that people actually wanted to come to. And so like, that to me was way more difficult than I ever could have thought. And by the way, it's like, every firm is always a work in progress. Like, you're always building. There's always things that are happening. And so like, to me, it's always like, the hardest part of that about this business is building the right infrastructure to support the kind of client deliverable that you want, and finding people that want to be a part of that and are comfortable with leaving these gigantic wirehouse types of platforms to come into the independent space. Like, that's always the hardest part, in my opinion.
Well, and so I know like early when you're talking to prospective partners, that may be a competitive situation with other potential buyers, particularly if they've hired like an Alaris and we're talking to multiple buyers. But how did you compete against better, and let's say more capitalized firms that could maybe write a bigger check than you could when you guys were first starting? What are some of the things that you leveraged to win those opportunities?
I wish I could say it was my charming personality, but I think like those that know me know that is like categorically false. So, it's tough. I mean, don't get me wrong, it's still tough today. I mean, there's always bigger firms that have more money, and like, unless you're one of the top 2 RAs out there that are mega RAs, there's always somebody that's bigger, that's more well capitalized than you. So I don't mean to sound like I'm preaching on a soapbox here, but for us, it really is just like finding people that are culturally the right fit. And like, it's not necessarily just around the most amount of money up front. Like, that's cool and that's important. But most of the people that we end up working with are less around, hey, I want to sell my business and then be retired in 2 years. And most of them want to just continue to grow, right? And so the upfront amount of cash that we can pay might have been less than an RA that's got 500 billion of AUM. If culturally we're the right fit and like we believe in each other, then, we're going to grow together faster. People will be happier, and ultimately they'll make a lot more money in totality with us. And that only happens, by the way, if we're doing really good stuff for clients. It's like, so for us, we always focus on that. I think that is a very overlooked part of this whole thing. Of like, if you have a time frame that's longer than I want to be out of here in the next 12 months, like, client deliverable, cultural and philosophical alignment. Am I going to be happy? Do I like these people? Can they help my clients? That's really, really important.
Yeah.
Because that's how you're going to make money in totality.
So, I mean, we, at Alaris, we spend a lot of time trying to get that cultural fit right between firms. Would it be fair to say, when you have an initial conversation with a potential seller or partner, are there things that you would look for that they would be talking about that would be early indicators that this is probably not a fit for us?
100%. So there's a few things that are just like hard stops for us. So, and not that there's anything wrong with that I'm about to describe. It's just not who we are, right? So, I know that there are some great teams out there that want to run their own private funds and things like that. And there are plenty of firms that would love to have them. For us, like, that's just, we don't want to be cheap GPs and private equity, private credit funds. I mean, we'd rather just do due diligence on, like the Blue Owls and the KKRs of the world, and have that as a deliverable versus trying to build that internally ourselves. And so, things like that, they're probably just not great fits for us. They wouldn't be here. They wouldn't want to come here. Guys who want to run hedge funds, probably, same thing. Also, while we have some advisors that have a broker-dealer affiliation, most of that is more for like legacy
Accommodated
trails and an accommodation. So for the advisors that are heavily dependent on both advisory and broker-dealer, they wouldn't be happy with us as well. And so while it takes more time to figure out who is the right fit, it's actually pretty easy to figure out who's the wrong fit, if that makes sense. And I would say it's just as much about those sellers figuring out whether or not we're the wrong fit for them as it is for us to figure out if we're the wrong fit. Once we go through the initial, like, yeah, this isn't going to work, or I think there's some potential there. When there's potential, then it takes a long time to figure out, are we really compatible, right?
You're saying things that like people want to get to culture. That's sort of where they start with, because what everyone talks about. But I think you should first try to measure compatibility, because culture to me is an experiential thing that you can only learn by spending time with someone. The question is, we believe you should first attempt to measure compatibility on all of the objectively measurable things. And if you pass that screen, then you can say, okay, this is a firm that we want to spend time with to see if we can get to cultural conviction. So you're talking about some things that I think are really easy to identify. For example, if a seller was engaged in private placements or they're a general partner for a Pollen, that would be just a non-starter out of the gate. Well, that's a really easy thing to, once we know that is your position at a Pollen, we could screen any potential partner that had something like that in place that would never even get to you. And so It's trying to figure out what are all of the objectively measurable compatibility points that you would say this isn't a Pollen potential partner, and then have someone that can vet that, whether it's you, third party like Alaris.
I agree 100% with what you're saying, by the way, because you just said it in a much more eloquent way than I could. Everybody wants to talk about culture, and then sometimes people say everybody talks about culture, like culture's not more. Like, every firm has a culture. It just may not be a culture that you want to be a part of, right? And so, but figuring that out takes more time, and there are just some real easy things that you could go through, not to make it sound like a checklist type of thing, but just as you mentioned, there are just some things that you as a seller must have and that we do not want. And if your must-haves are things we can't have, what's the point of even continuing the conversation?
And so that's a really good tip, I would say, coming back to how to be a good buyer, is knowing what are your points of incompatibility. Like, what are the things that you would just not say is a good fit from a compatibility perspective with our firm, and then be able to quickly disseminate that to the seller that you're talking to and identify if we should even be talking because we're compatible or not compatible. I think so your fee model, your custodial, your tech stack, your deal structure. It could be that you talked about it early. You're not really seeking firms who are looking for a quick exit. That's an easy point of inference from a compatibility perspective. And so all of these things, I think that's a really good idea for buyers to have. What are your mandatory points of alignment and things that you're going to require? And we can quickly vet those against the seller model and what they're seeking. So let's talk about winning deals. Let's say you're talking to a firm that's compatible. They check your boxes, you check their boxes. Does it come down to personal chemistry, you think? How well you're vibing with this firm?
I'm going to answer it from my view. And so I'm sure you could talk to a bunch of our partners that have joined us and they may have a totally different view on it. I think so. I mean, people have a lot of choices, and at some point, I feel like we are uniquely different. I bet you that every firm that you would talk to feels like they're uniquely different. Yeah. Nobody's been, we're totally the same as everybody else. No matter what, I'm still going to believe that we're uniquely different and have a strong value proposition. I just believe that, my heart of hearts. That being said, I think at some point, it's just going to boil down to you have three firms that you're gelling with really well. And the deal structure might be a little bit different, but they're all pretty good. And it just comes down to what team do I feel like I'm going to have the most amount of success with? And that really just boils down to your personal chemistry. So much longer way of answering your question, which I could have just said yes. But yeah, 100%.
It's so subjective. If we're doing our job right as the seller's advisor, every firm that we invite to the process should be compatible. We've cleared that screen before we even introduce the parties. So therefore, it's usually very close. In our processes, it's very hard for the seller to pick because they're all of the firms are compatible. It does come down to that subjective emotion, just who they like, and a lot of that is driven by the buyer and how they pursue the firm. Would there be any tips that you would give? Say I'm a would-be buyer, haven't done my first deal yet, and I'm thinking about jumping into the M&A game. In terms of the courtship, are there any tips that you would give, things that you learned the hard way coming up through the process.
Yeah.
Either to
Well,
do or not to do, wherever you want to take it.
just know it's way easier to get into a partnership than it is to get out of a partnership.
Yeah.
And it's like, take your time. Like, I know a lot of times you and I are working together, things like that. Sometimes you or people want us to move faster, and I might be a little bit more methodical. But I do that because sometimes you have to move slowly to move quickly, if that makes sense, right? Like I want to make sure that we're doing everything that we can on the front end to make sure that we don't get to a scenario where we're trying to break up in the future. It's a lot harder after the fact. I would take my time. Also, one thing that was interesting when we first started, and I know you asked me this question earlier and I didn't really answer it. Even though we had recruited people at our prior firm when we'd never really been in the M&A space before, sometimes we didn't know what were the hard stops for us until we had a lot of conversations. It's like it took us some time to figure out exactly who was the right fit for us. And that came because we had a lot of conversations with people to be like, well, how would this really work? Right. And like, you kind of have to move past the excitement of like, man, once this person comes over, my firm's going to grow and all that. Like, that feeling will pass. And then you are potentially left with somebody who is not the right fit for you. And like, you don't want to be there. Or, that feeling will pass and you realize, wow, this person or team is a great fit. I'm so glad we did this. I kind of want to remove the emotion from it and just like figure out what this is going to look like together 2 years from now. And if I am having trouble and challenges on the front end before people even get here, like it only goes downhill.
That's a great point. One, I really love trying to remove yourself emotionally from having to have the deal. I think a lot of buyers, particularly when they're young in the M&A space, that they chase deals that they shouldn't be chasing. They're being driven emotionally instead of like rationally. And so I think that's a really good tip. And it requires, now you said that you really didn't know what your hard stops were day one. It just required multiple conversations going down the path. So you should be prepared for that as a buyer. You'll get better over time at identifying really quickly, like who's not a good fit for you. And you'll learn the questions that you should ask very early in the conversations to get to that point. But it just takes time. So you've got to be willing to slug it out probably 10 times the conversations that you would have 10 years later when you're a seasoned vet at doing transactions. But your criteria did evolve. Let me ask this question. I think I know the answer to it, but do you find from a seller perspective, like there's a consistent issue that you have to overcome in virtually every conversation? Like I know what it would be for me, but I'm curious is like, what is a chief seller concern that you find yourself having to overcome?
So I don't know if there's one single issue. There tends to be one of like 2 or 3 issues that each person has. Like, a lot of times we'll talk to people that are at a wirehouse and they want to lean, and like their primary concern is, can I even get out of here?
Yeah.
Like, so that's its own thing. And then sometimes we talk to people that have their own firms and they're so used to being in control over everything.
Yeah.
Like part of the issue is like, this firm is kind of my identity. Like, what happens to me if I become part of a larger firm? And like, so that's another challenge of just giving up control.
Yeah.
Like, to me, those tend to be the 2 big issues.
Yeah, we don't do a ton with wires, but I do believe that's the constant issue that they're dealing with is what is the legal, like litigious outcome if I decide to leave. But certainly I would agree in the independent space, which is where we live, it's overcoming the fear of giving up control or losing control. And here's the reality, and you can speak to this. You're not looking to acquire a firm that's got entrepreneurs at the helm and remove that entrepreneurial spirit and turn them into a robotic employee that's just doing your bidding. That's the opposite of what you want. You want to retain their entrepreneurial spirit, but just remove a lot of the burden, the things that they shouldn't be doing because it's not accretive to growth or satisfying them personally.
Yeah. So, I mean, our model is a little bit different in that, I'm going to use a really bad analogy here. So like, forgive me. I'm not trying to suggest that we're a wirehouse. If you think about like a wirehouse branch, like that is typically run by a branch manager, but like think about our branch manager as, the top producer in that marketplace, who then grows their own practice and then also brings in other advisors there. And then they own that location with us in a real partnership together. Like, that's our models. Like, we very much want the entrepreneur, but we want the entrepreneur who realizes that the highest and best use of their time is to not build the platform, but is to grow their local presence. And like, that's who we're looking for. A lot of times we'll find people that have just, they're exceptional at doing that, but they've hit the ceilings for one reason or another. And listen, building and running an RA is incredibly difficult. Building and running an RAA and being in production and recruiting in working with other advisors and doing that all yourself is like almost impossible.
Yeah.
And so at least if you want to do it at a highly competent level. And so we want to find the people that want to partner with us so that they don't have to build and grow the platform and make sure that there are great deliverables. Like, they expect great deliverables. They expect us to do those things, but they want to continue to grow and serve clients and figure out ways to do more of that in their marketplace. And like, in partnership with us, that'll work. Not every firm does that. I'm not suggesting we're the only firm that thinks about it that way, but that's just how we think about it. So we very much want that entrepreneur to want to continue to grow. However, if you are deeply passionate around building the platform, running the RA, like, you should do that. And we're probably the wrong fit, and most firms will be the wrong fit because you want to build the platform, not be part of one.
Well, let me maybe take a different approach to one question. Are there any, let's say, diligence mistakes? This is just like part of learning the hard way, like things that you learned by doing it wrong or not doing it right, I should say, in your discovery diligence process, that you would say this is something we learned?
Inspect what you expect, I guess, is the easiest way that I could put it. Very early on, it was, we were smaller and we didn't want to bite off more than we could chew. And so we ultimately ended up partnering with, at the time, which was really big for us, but they were smaller in nature. It's not like we're trying to go after a $2 billion firm when we were, $400 million of AUM. And so some of those things where we got numbers, but we didn't validate as well as we should, we learned pretty quickly, like, there's better ways to validate. And I really have to look at these things versus just taking somebody's word for it or looking at, one sheet of paper. Like, I really got to dig into those. But like, it didn't really burn us because, we were smaller, they were smaller, and like, we grew through it, and we, it was pretty easy. It's a lot easier to double in size when you're 400 million compared to when you're 14 billion. Some of those mistakes we made early on, but I would just say, like, it required us to bring in, somebody who's exceptional with us, Mike Herman, who I think who's our chief compliance officer, and he forced us to step up our due diligence process and to really inspect everything that we're expecting and everything that people are, saying to us. He made us make sure that we had all of the support behind it, and not just like 1 year's worth of support, but many years. And like that, honestly, that helped us avoid a lot of mistakes early on.
Your compliance officer, Mike Herman, was the CCO at United Capital when I was leading their M&A charge for 8 years. And I'll tell you one story real quickly. So like, we had a deal. It was a great firm, but they had a private placement they were invested in. And to your point about not wanting that type of thing. And it was a very small thing. We weren't really adding to it. But Mike did a very deep dive on that fund. He uncovered a couple positions that he thought were problematic and basically gave a recommendation to our CEO, Joe Duran, that they not move forward with the transaction because of that holding that they had. And of course, I was the deal guy, so it infuriated me, but because we were losing an opportunity. But we didn't do the deal. And then like a year later, that thing blew up in that portfolio. And that firm was all over the press. It would have caused like major problems for United had they done that acquisition. And so having a team that knew what they were doing, sophisticated, could highlight those areas of concern, and then listening to them, when they raise those points, I think is instrumental. And it's the thing that transforms a smaller firm doing M&A into a more mature one. So that's a point. Like, when did you make the decision? Because it was you and Rob, right, for the first few years the primary people. Call it, you are the corporate development team, the integration team, like you guys probably have it all. When did you say, okay, we need to start hiring like real talent in these functions that made us better?
I mean, I've always been a big believer in making sure that we're hiring people that are just way better at doing the things than we are. I mean, if we are the best people at everything in the organization, like we are not building a lasting organization, period, end of story. When we were smaller, we had less money. And so we couldn't attract over the mics of the world.
Yeah.
And so it took us a little, like we always wanted to get like the best people out there. We couldn't afford to bring them over, and they didn't want to take serious steps backwards to come to us, right? I mean, I think that's sort of the thing that we talk about. For us, growth is the enabler or the debilitator of our future successes. If we keep growing, we'll have the ability to continue to attract in really high quality talent, which we have, and we'll have career paths for people. Nobody wants to stay in a dead-end job. So it took us till the end of 2020, where we were basically eclipsing $1 billion. We had done our first few deals, went from March of 2020 when we were 440 till the end of the year. We, just had surpassed $1 billion of AUM. Like that was our first inflection point where we started to hit some like real serious growing pains. We're like, man, we need people that have done this before. And every time we hit that inflection point, like it forces us to go out there and find people that have been there, done that, and we want them to come here and help us break through and take it to the next level. And
you had a choice when you slugged it out until you got to $1 billion, and rather than start taking that cash flow that you're probably making more money at that point, you had the ability to take more money. You decided to reinvest it back into your infrastructure.
That's right. Yeah, but listen, it was hard, right? It was hard because we were fighting through just like nonstop challenges. And those challenges were not going to get any easier. We needed to fix what we were doing in order to make those things go away. And the only way that we could make them go away is to get the right team in place so that we could grow through it, or we needed to scale back and get to something where we could manage it for the skill set that we had. And like, we just didn't want to take steps back. We wanted to push through it.
Well, that's one of the best advice you just gave right there. It's like, you have to make the decision, because you can either be small or big. You can't be in the middle. That's really a painful place to live. And we frankly deal with a lot of sellers who are struggling with that decision. They've grown to their ceiling of complexity, and they're now asking themselves, should we invest and try to get bigger on our own, or should we transact and partner with another firm? And you guys came to the conclusion that we want to invest in ourselves. But that was a tough decision, and it was a lot. There's financial ramifications of that. And I'm sure you and Rob and the team had a lot of brain damage going through that process too, just fighting to get to where you are today. It's paid off, but not everyone makes that decision, and not everyone succeeds if they did make that decision.
Well, I mean, we just want to be happy, and we want to work with people that are happy working with us, right? And like, when you get to that point where things are just a constant struggle, it makes you take a step back to figure out like what does make you happy. And sometimes people will say, like, I'm happiest in front of clients. Well, great. Then you should do that. And for us, what makes us happy is to continue to grow, to continue to expand, to bring in really good people. Like I don't have any other vocational skills other than this, so I enjoy doing it. And, I feel like I've got another 20 plus years left in me. Trying to all of a sudden figure out a totally different path was not what we wanted to do, right? We didn't really have much choice other than for our own personal happiness. We needed to invest in the things that we invested in order to break through and keep going. And so but that was the way that we wanted to grow. Yeah. Some people want to, move in a different direction. I'm totally cool with that too.
Well, let me ask this question. So I assume when you started, you were serving clients as an advisor?
My entire career have always been in some type of leadership role. I was an advisor for about 6 months and then became the managing director when I was 24 years old at my prior company, and kind of the rest was history. And so I've always only worked with clients for about 15% of the time.
Yeah.
When we started this firm, a large percentage of my time was spent doing direct client interaction because that's what we needed to keep the doors open. But as time has passed and we've gotten bigger and we've gotten more people involved, like we have far more capable financial planners and advisors in the organization that I still love the clients that I have worked with for my entire career. but they work with other advisors in our firm, and they are still good friends of mine. And I talk to them like, but the work is being done by other people, and they're happy, and I'm really happy with that too.
Well, that's an important decision to make for all the CEOs is like, when do you ever stop working directly with clients to focus on running and managing the business? And then when do you do that? I think it's important because you have to have, that's one of the things that we like about firms like a Pollen or larger firms that have dedicated C-suite people. Those people, all they do is run the business. They don't work with clients and run the business. And therefore you would, let's assume, just equal competence. If you're spending all of your time doing something, you're going to be better at it than someone who spends half their time. And so like that.
100%.
Yeah.
Well, listen, being the CEO of a multi-billion-dollar RIA and dealing with the complexities that comes along with that, and doing M&A and dealing with attorneys is totally different than working with a client and taking them through their financial situation and making sure that they're staying on the right path. And it's really hard to do both.
Yeah.
And so I wanted to make sure that we created an environment where I could still be really good friends with these people and these clients, but bring in advisors within our organization that could continue on and work with them. Like we've done that, and it's been awesome and it's been great. And so I can focus on the things that I want to and still have super strong relationships with some of the best clients of our firm, but they're working with other advisors in the organization. It's been great for us.
Yeah.
They're happy. I'm happy. We grow better, faster, and the clients are in better shape.
Understood. All right, last question for you. What would you say, having done a number of transactions, that sellers care about post-close that buyers consistently underestimate?
Is it what I thought it was going to be like?
Right. Does it match with what my expectations were?
Are they delivering on what they told me it was going to, what they said they would do? I think that is the most important thing that I could share with people is like, if you tell somebody that you're going to do something, you got to do it.
Yeah.
Don't just say it to get somebody to come over. I mean, they'll know and they remember and they expect it of you. And so be honest with who you are and what you're all about and deliver and exceed people's expectations. And everybody will be happy. And if you don't, people will want to stone you to death, and you'll be running, hiding under your desk all day long.
Yeah. Well, being able to, I love that answer. And I think it's accurate. It's not that they expect you to be perfect, but they do want you to deliver on what was promised. If you can't deliver on that for some reason, to overly communicate with them as to why and what the plan is going to be moving forward. And if you do that, you'll find that in most scenarios, not everyone, but most scenarios, your new partner who joined you will work with you and they'll be fine. But it's when you stick your head in the sand. And
if I'm expecting A and it's really B, I'm going to be very dissatisfied unless B is pretty damn good. Right. And so to me, that's the thing that never ceases to amaze me when people are just saying anything they can to get the deal done. You got to live with, everybody's got to live together afterwards. This is not setting up this marriage for success here, right?
No, I like that. I think, again, don't say things just to get the deal done, because to your point earlier, it's a lot harder to unwind them than to say no up front, because of a mismatch. Right. Well, awesome chat, Mike. I appreciate the time.
I appreciate you having me on.
Well, this will be helpful, I think, for all the would-be buyers that are out there. And sometimes I feel like we're trying to discourage them from becoming a buyer, but I do want them to know going into it, eyes wide open, how difficult it is and how excellent you have to be to compete today. And so yours and Rob's growth at Pollen is a testament to how excellent you guys have been. We've done a number of transactions with you guys, and every one of them are very happy on the other side. So thank you very much.
It's extremely rewarding to be a buyer. You just have to know what to expect.
All right, Michael.
Hey, man. Well, thanks for having me. I really appreciate it.
Yes, sir.
All right. Well, back from that, it was such a great interview with Mike. I love hearing him speak about his journey and little tidbits I hadn't heard before.
I'll tell. Yeah, he's awesome. I'll tell one quick story. Hopefully Mike wouldn't mind this. When I decided I really love Michael Dolberg, when I was talking to him, we were onboarding them as a buyer, and we get their legal entity names and such. He was sharing their holding companies names, and it was PWW LLC. And I said, what does that stand for? And he mumbled really quietly, Prestige Worldwide. And for those who don't know, there's a movie called The Step Brothers with Will Ferrell and John C. Reilly. And that was the name of their company that they formed to go through shenanigans, global domination in media and stuff like that. So I knew I had an instant connection with Mike when he named him and his partner chose Prestige Worldwide as their LLC name. So I thought that was awesome.
Did we just become best
That's
friends?
right.
Yeah.
Exactly.
I love it. All right. Well, it's a great episode. I will see you soon.
All right, Jack. See you soon. Cheers.
Bye.